Thank you, and to all of you, welcome back from coffee. The topic of this panel is the evolution of global banking regulation, and it's basically from Basel I to Basel II to Basel III. A lot of bankers actually suspected that there would be a Basel IV around the corner, but I certainly never made it to Basel IV, and as far as I know, there is no such thing. Maybe sometime way into the future. Together with my well-known colleagues, we will sort of talk about where we came from and what lessons are to be learned from that. But before that, since I also happen to be the chairman nowadays of the Toronto Center for Leadership Training of Supervisors, and the Toronto Center was established 21 years ago, not 20 years ago, and we're sort of working in the same field coming out of the Asian crisis, so on our behalf also a happy birthday. And we look forward to many years in the future when we continue to cooperate. And the FSA has been highly successful when it comes to delivering on its mission when it comes to creating a network of supervisors and central bankers throughout the world, keeping track of what is going on and discussing how to do things the right way. Let me give just a brief introduction when it comes to what we are talking about here this morning. First of all, the regulatory framework, the way it has evolved over the years, has become far more expansive and far more complex, particularly if you were to compare the number of pages discussing Basel III compared to Basel I. The number of jurisdictions has also increased quite a lot. First in a technical sense, because the committee expanded its membership back in 2009, but also in addition to that, there are many more interested parties today than there used to be in the past. And at the sort of anecdotal level, back in the 80s when I was in the finance ministry, when Basel I came into fruition, I went to the Ministry of Justice and said that we have to do this thing called Basel I. And one of the judges said, "Show me the international treaty, why should we do this?" And there was no treaty. I said it was kind of a club, so we're expected to do this. And it took quite a while actually before I could convince the judges that no matter the legalities of this thing, this is actually what we're expected to be. Now also what has happened is that there are many more stakeholders involved in the past, and also many more banks are actually today all over the world covered by Basel III. This has also created an environment where all the interested parties want to have a voice, and also from time to time the political interest in what we do has also increased substantially for two reasons. One is of course the financial crisis that we went through about 10 years ago, but the other aspect of it, which probably always will be there in one form or the other, and that is substantial lobbying on the side of the private sector. Today, in terms of what we have done, the issue is timely, consistent implementation of what has been decided, and that's a challenging topic because it takes time to do these things. It takes time to pass rules and regulations at the domestic level, and also to give you a sort of a feeling. And this is an issue where the FSI has done very good work. This is something that matters to more and more jurisdictions and banks, because you kind of keep track of around 100 jurisdictions and what they do in terms of putting in place Basel I, II, or III, and 60 some have put in place Basel III in one form or the other, or they're on their way doing it. Around 10 do Basel II, and around 30 do Basel I. So right now we have kind of a mixture of all these frameworks being in place, but all the jurisdictions, whether they're a full member of the committee or not, are kind of moving in the same direction. And it's really a worthwhile undertaking of the FSI to keep track of what is happening, because otherwise we basically have no idea what countries are doing, and that is good work, and that also means that the Basel Committee has become, or is on its way of becoming, truly a global standard setter. Now, why did it take 10 years to get this thing done? Well, if you have more interested parties than in the past, you have to talk for a while. And all those interested parties have strong views on what to do and what not to do. And it's impossible, given the size of the Basel III undertaking, to sort of negotiate a kind of a general equilibrium negotiation where everything is done at the same time. So there are many, many moving parts, but you still have to do one section at a time and then eventually see if the things add up. And that really takes time to do. That doesn't mean that every imaginable problem in the world has been fixed. We still have issues, like we heard in the other panel this morning, deficiencies when it comes to governance, poor risk management, and interconnectedness and things like that. And the perennial issue, I think, which is with us all, is to avoid too much over-engineering. Because there is always an interest on the side of the rocket scientists to add two more complicated equations, and then you argue that the system is just as safe it's just as safe with a little less capital, providing that we add a sufficient number of Greek letters. And that's a tall order to sort of manage that process. The Basel Committee is actually in the process now of putting together all the documents that have been produced over a fairly large number of years into something called the consolidated framework. And the so-called consolidated framework, or the rules text, if you may, now amounts to 1,500 pages. So that's what we're talking about in terms of keeping track of this thing. We can argue if that's a good thing or not such a good thing. It's much, much more anyway compared to what was in Basel I, which I think is sort of 25 to 50 pages or something like that. So something has happened in this process. So with this as a bit of an introduction, I'm going to pose three different questions to the panelists, and I'll begin with Sabine, because you joined the Basel Committee at the onset of the great financial crisis, and you have been a member of the committee essentially through two major episodes when it comes to this. First one is Basel II, which you kind of inherited, and all the implementation issues and all the arguments whether Basel II was good or not so good and needed to change. And the other part of it is Basel III and all the ups and downs when it comes to finally producing Basel III. And now the issue to you that we will get back to in a few minutes is to what extent you think that we reached the right balance. To note, you were chairman in the middle of the financial crisis. And then, of course, when something difficult happens, then the resources were obviously stretched. But at the same time, there was a very clear and serious collective will to take action because things had gone wrong and it was obvious that something had to happen. So it would be interesting if we could hear your key takeaways on setting safety standards in the middle of a fire. It's sort of like fixing the hose while the house is burning, and what kind of experiences and thoughts and reflections you have on from that process, and also could we have done things differently. And finally, to Shamsia, the BCBS is a global standard setter, and that of course raises the issue when it comes to implementation and the type of standards that we have produced, to what extent these standards are actually also applicable to non-member jurisdictions, and how we should deal with this issue going forward, because more and more jurisdictions take a great interest in the work of the committee and try pretty hard to apply these standards in their local settings. So with this as a bit of an introduction, then first Sabine, please go ahead.
So I was asked whether the balance is correct, yeah, with regard to Basel III. I think overall, yes, it is correct. I think we got it right with regard to risk sensitivity, having belts and suspenders, you know, with kind of backstop measures. Would you ask me whether I'm convinced that each and every transaction we got it correct with each and every asset? Well, I have to admit I doubt that, yeah. But I doubt anyway that if you want to stay with risk sensitivity as a major objective in capital requirements, I doubt that you can ensure that you have the perfect risk sensitivity for each and every portfolio, for each and every instrument. It's more an aspiration you have to, you know, you have to have. And I do remember quite well that we had passionate discussions in 2010, 12, 14, 16 about risk sensitivity and simplicity, and whether risk sensitivity should anyway be something as a basis for the capital requirements. Yeah, we did have some members who said just take simple measures. Basel II brought us the problems, and we should change this. I have to admit I'm still in the camp of the ones which would like to have risk-sensitive capital requirements. I truly believe that the incentive setting with measures which do not take care and take into account at all the risk which banks take in with their business activities, but just give a simple leverage ratio, for example, above everything, that this kind of incentive setting is the wrong way. And I mean, coming from the implementation of Basel II, yeah, when the crisis hit us in 2007-8, the capital requirements were mostly calculated still, and the transaction were done under Basel I. Which was not as risk sensitive. So for me, higher risk means higher capital requirements, lower risk means lower capital requirements. Does this mean that I'm a kind of financial engineering and I love the Greek alphabet? Well, up to 80% I like it in order to give me a trend, yeah, and I think that we did quite well. But you should not believe that whatever the models give you will be the reality to 100%, and that's why I think we did it correct in then using belt and suspenders, meaning we introduced input floors, we introduced output floors, we had a leverage ratio. Yeah. Does this mean we have a simple framework? No. I think we have a complex framework, and perhaps the 1,500 pages would have not been necessary, yeah, but I cannot imagine that we come back to 25 or 30 pages with a risk-sensitive framework. I think there is a misconception. If you have a heterogeneous group of banking systems with different banking activities, different markets. Yeah? When you have complex financial instruments, I'm not so sure that you can grab capital requirements with only a simple measure. Yeah, I think this is a misconception. A complex problem is not always solved only by a simple measure. So I think we have to live with a little bit more complexity. And we have to live too, I think, with the obligation of the supervisor to grab the gaps and perhaps the mistakes done, but perhaps not even the mistakes. Better to say you have to grab the individuality of the risk profile of the bank in comparison to a legal framework which usually does not take into account the individual risk profile of a bank, but something more on average. Hence, we do have Pillar 2, and looking forward, I would all see us looking much more into the Pillar 2 aspects and how to cater, for this average risk taking capital requirement on the one side and the individual risk profile on the other side. So for me, yes, the basic architecture of Basel III is correct. Here and there, we probably will do some fine-tuning over the years, but the framework as such, I think we did a solid one.
Thank you, Sabine. Now you saw this sort of emerge in the middle of a crisis.
Yeah, unfortunately. Well, let me first congratulate also the FSI on its 20th birthday. It's a fantastic institution, and you and I, we traveled quite a lot for the FSI, just to make clear what the institute and the institution is doing. Second, it's good to be back in Basel after, 8 years? Every now and then I still thought of Basel. Marvelous institution. I can't say that I every night thought and dreamt of Basel, but I often did, and I followed the Basel studies closely, and I can only congratulate the institution, the Bank for International Settlements, with its activities. If you allow me, I would like to look from a certain distance at the situation. And I went back to my first speech, the first speech I delivered as chairman of the Basel Committee in February 2007. It was a speech delivered at a risk management convention in New York. And in that speech, what I did is I identified, and I have to add, with the help of really a fantastic secretariat of the Basel Committee, I identified so-called pressure points. These pressure points were new risks emerging from the change in the business model of banks from buy and hold to originate to distribute. That was the period in which that happened. And I literally said, and I would like to quote myself, and to some extent also punishing myself, these developments have created many opportunities to improve the way financial institutions manage their risks and risk exposures. Risks are now more widely distributed outside the banking system. There are more tools to manage risk concentrations. Risks and how they are priced have become more transparent. As a result, deteriorating credit exposures can be managed more actively at an earlier stage. This is what I said in 2007, February 2007. While admitting that there is a great deal of uncertainty around the nature of risks in the markets, I concluded my speech on the following note. Basel II, I said, provides a structured framework for discussing some of the new risks we are seeing and for creating incentives to better measure and manage those risks. By just substituting Basel II by Basel III, I could have delivered more or less the same speech now. And I think we should a bit reflect on its implications. 3 months later, I said that was almost at the eve of the start of the first phase of the financial crisis. I again stressed the merits of Basel II in support of financial resiliency. And I said, and I added, especially in this age of rapid change and innovation. That is what we have heard this morning also several times. And nobody, dear colleagues, nobody mentioned at that time the need for, let alone the unavoidability of a Basel III. On the contrary, when I accepted this chair, I was promised, and I accepted that chair at the end of 2006, they promised me that there would never, ever be a Basel III. Well, lessons from the past. So keep this in mind. What happened? We got a Basel III, and some people think, and other people believe, that there will be no Basel IV. But the train has left already from the Basel III station, isn't it, Sabine?
It's all a question of definition, you know.
Well, reflecting on the past and also looking at what I said, and I went through a few speeches from those days, it's clear that the 2008 crisis functioned as a wake-up call, also for supervisors. But last year, let me first say the real capital, this has been mentioned already, in the banking system was embarrassingly low. Just a few, the real capital, profits, capital and retained profits. The real capital was extremely low, just a few percentage points. Banks were allowed to treat some of their debt as capital. Most supervisors had forgotten that liquidity could become a problem also. And I remember that from my own experience. It was not on our agenda at all. So as to real capital, there was a problem, a visible problem. Last year, I read John Kay's Other People's Money. And as to risk management, he speaks of the breathtaking scale of misapprehensions. Quoting prominent central bankers, Greenspan, Bernanke, and supervisors, he could have quoted my speech, who thought that financial innovations had made or could make the system more resilient and flexible, and stressing these people that banking organizations had made substantial strides, I'm quoting, substantial strides in their ability to measure and manage these risks. That was at a moment that, admittedly, with the benefit of hindsight, that was at the moment that big banks couldn't oversee and assess their total risk profile. Due to serious data aggregation problems as a consequence of problems with definitions, problems with IT system. Only this year, I think most of the banks have solved these problems, 10 years after the crisis. But again, going back to 2018, the risk management of the big banks was not under control. And then as to transparency, under our own eyes, we saw the financial world becoming less transparent with the introduction of so many innovations. And we also saw the remuneration level skyrocketing to indecent levels in a sector that indeed deals, and I'm quoting John Kay's book, sector that deals with other people's money and should be built on trust and confidence. And I still, and that's why I said I want to take a bit broader perspective, and I think it's relevant also for the future. I still ask myself why our, talking about the supervisors, alarm bells haven't gone off more loudly. I have heard bells ringing with Christmas and other occasions, but also alarm bells. But why not more loudly in view of the fact that, as I said, the risk capital was embarrassingly low, the situation was becoming daily more intransparent, and the risk management of the most important institutions was not up to the standard. As I said, I still ask myself that. And I know we did our utmost to address all these issues. And we worked day and night immediately after the unfolding of the crisis. But the fundamental issue remains, and that's why I'm telling this story. The fundamental issue remains, how come that we as regulators and supervisors worldwide didn't see and realize that the banking sector was getting out of control? We didn't see that. Let's be honest. I'm not talking about forecasting mistakes with respect to GDP growth and so on and so forth. No, this was under our eyes. We didn't see that. And my feeling is, and again, that's why I'm mentioning this, my feeling is that as long as we don't understand don't fully understand, at least, why we failed in the past. We are not sufficiently prepared for the future. And therefore, a crucial issue is, do we really understand, in all its implications for the financial sector, what is happening today in the technological field, especially in the technological field? This has been mentioned earlier this morning, and I will come back later on during the discussions to this point. I've been asked what my key takes away are on setting safety standards in the middle of the fire, what could have been done differently. Let me first speak about more or less the procedure. When it comes to concrete actions taken by the committee, I agree with Sabine. What we did was directionally, at least, was correct. Whether we should have gone further, I don't know, but in the real world, you at a certain moment have to compromise on certain solutions. We addressed directionally the flaws in the system that came to the surface, and under the pressure of the circumstances, we did it in a reasonably short time. Just a few years compared with the time it took to finish Basel II. This was really very fast. We did it in a very short time. Everybody's credibility was at stake. That is one of the reasons. And as chairman of the Basel Committee, I saw from the beginning on, as my main task at least, to prevent all the people sitting around the table were more clever than I were in the supervisory field. I came from the monetary, let me say, department of the central bank. But I saw it as my main task to prevent the focus from getting bogged down in endless technical discussions. Speed was required and a broad supportive basis. And that's why we also enlarged the membership of the committee, and that was very helpful. For example, China was very helpful in the discussions we had in the committee during those days. We involved our highest governance layer, GEOS. That was also necessary because when these technical discussions took too much time, and then I called Jean-Claude Trichet and I said, the GEOS should give us instructions, and these should be the instructions to be given by the GEOS, and then I could more easily deal with the membership of the committee. And the heads of states were also very helpful. It was in they had a vested interest in it, but to my great surprise, at a certain moment, we even got a letter of Mr. Obama and Brown and some other heads of state just to make clear to us, don't go too much into the details, please come with a proposal. I think still think this was the right approach, broad basis, political support, firm commitment at the highest level. And we, from the beginning on, we realized indeed that there's something wrong with liquidity and capital and so on and so forth. The actual situation in the membership of the committee, differed from country to country, let me put it that way. And that made it necessary to find compromises. But if you try to find a compromise, you have in your mind kind of an end goal. And if you can't get that end goal immediately, what you should do is you should introduce, how do you call that, introductory periods, implementation periods. And that's what we did. When the end goal was too far from today, we said then it's for tomorrow, the day after tomorrow. I always said that there would be first movers, so that by introducing the phenomenon of implementation periods, less worse than some people think, because competition will start the moment you have introduced a certain measure. If the question is, could the BS have done more as a committee in addressing these immediate, extremely pressing issues? Well, I'm hesitating a bit. On the one hand, I fully agree with what you said. We did what we could do. But then, reflecting further on it, I said to myself, we were dealing with today and tomorrow, but not with the day after tomorrow. I will come back later on with that issue. We were dealing with the immediate issues, and we tried to solve the immediate problems. But perhaps we should have reflected a bit more on the future, because I said Basel II became Basel III. Basel III, whether people on the committee now say there will never be a Basel IV or there is no Basel IV. There will be a Basel IV, there will be a Basel V, unless we are going to change fundamentally the approach. I think I don't have an answer in this respect, but I think we should reflect on it. And the Basel Committee could have started to reflect on that. That is one element, and whether we could have done more, but perhaps it's not fair because we were so busy during those days. And there is another, I think, thing we could have done also during that period. We could have tried to give advice to all those at that moment involved in very complicated discussions with their own banks and who were doing that on a national basis. We in the Netherlands, we were discussing ABN AMRO at a certain moment, or we were discussing iSafe. We tried to discuss that with the supervisor in Iceland. We tried to discuss that with the supervisor in the United Kingdom. There were no connections whatsoever at that time. And I can tell you the period in which we, that was the period of the collapse of the Fortis, At that moment, when we tried to isolate ABN AMRO, just 2 months later, it became clear to me that RBS in the United Kingdom had enormous problems, and that there was a liquidity injection of, 45 billion or so pounds. What the BSCB, the Basel Committee, BCBS could have done is to ask at that moment more attention for how to handle the actual problems. That is, so three things, we did our utmost, and I think we delivered on the improvement of the existing standards, and we enlarged them a bit. Then we could have done more in the context of the immediate problems and giving guidelines to the supervisory community. For example, also with respect to dividend payments, different policy pursued in the US than in the UK. And we could have started a discussion as to the longer term future of the system. Thank you.
Thank you, Arnoud, for very, very interesting and good remarks, since you've seen it all. Now, Shamsia.
Well, is it true that the Basel standards are meant for internationally active banks? But the desired outcomes of the Basel requirements are universal, in that it is to promote resilience of the financial sector, particularly through strong capital and liquidity buffers. And it is also important for all jurisdictions to adhere to some minimum prudential and risk management standards for global financial stability, given highly interconnected global financial systems. But having said that, for emerging markets, the implementation of Basel standards are typically accompanied by some challenging questions. One is when you have a diverse set of players in your own market, a mixture of internationally active banks and your own indigenous banks. So how does that, when Basel standards are only implemented by a subset of players in your market, what does that say to, what does that mean for competition? And what could be the impact of rules in jurisdictions where capital markets are not as deep or varied as those in advanced economies? And on the same note, how relevant is the rule for domestic markets? Or are there certain rules within the Basel standards that are much more fundamental and should thus be prioritized over others? And lastly, policymakers in emerging markets will also look at the existing local requirements and see whether how consistent or otherwise they are with the Basel requirements, and what are the trade-offs that will emerge by replacing them with the Basel standards. And responses to these questions will inevitably vary across jurisdictions. And while it may be well reasoned within the domestic context, this variation can affect global comparability. And in the absence of an agreed set of principles that can anchor or give meaning to these differences, the natural default is to compare application and compliance closely against the Basel standards. And so, from an emerging country point of view, the BCBS and the BCG could specifically consider playing a role in incorporating these considerations in the architecture of the rules from the very beginning via closer cooperation, and this has improved considerably since the last few years, especially after the expansion of the membership of the Basel Committee. And secondly is to provide some principles or guidance or standards for the applications of existing rules on smaller and less complex banks. And identifying unintended consequences could be a good start towards incorporating some of these principles and guidance for emerging markets to implement these standards. Like I said, for emerging markets, the Basel standards are seen as the gold standards, and the outcome of this standard is something that is subscribed by all financial supervisors.
Thank you. Any quick remarks, Sabine, on what you've just heard from your colleagues?
Well, I think now that's correct that looking forward, we should perhaps have done a little bit more on a discussion on the systemic, the structure as a whole. We focused very much, in particular in the first years, on capital requirements, between 2008 and 2012. And I always feel a little bit sad that so many other papers, which are quite good, did not get so much of the public attention and perhaps were not so much promoted by all of us in the public domain. And here I'm talking about papers with regard to governance, which I think is very important as a supervisor to look at, but much more difficult because you cannot calculate it, you cannot put it into Greek letters. It's about stress testing, risk management. I just to give you an idea about the risk data aggregation, I mean, this famous Basel paper 239, by the way, the only paper which is always used with their number, it's quite interesting, we did, it's true, usually you use words, but this paper is known by the number. We did in the SSM a horizontal analysis about the fulfillment of the requirements in 239. And I truly believe, and here I agree with you, Naud, I truly believe that these kind of papers, this kind of work, needs to be done forward-looking too, in order to grab, a part of what was not looked at until 2010, 2012. Then I hope, that is at least my impression, that that the interconnectedness is looked at on a much deeper scale than we did before 2008. I wouldn't dare to say we are finished, but I think we are all much more aware, and not only the tools, but the cooperation on a whom do I know in the international community? The cooperation is much deeper, with regard to an exchange of information, of data, getting a joint understanding of risk emerging than it was in 2008. Do I believe that it is already enough, sufficient? No, not yet. I think here Partly I agree with Maud that we have to move even further, and we need to discuss much more risk and vulnerabilities and the methods and the actions which can be taken by macroprudential supervision when we do have a joint understanding of what here and there pops up. But this, I think, is for the next part of the panel.
No?
First of all, I think the system is much more complex than we did realize in the past, and it's about the interconnectedness, the interlinkages in the system. And only when we come to grips with these interlinkages, then I think we have made substantial progress with respect to financial stability. Yeah, whether what we have done was enough, this is in the lap of the gods, so to speak. Let's wait till the next crisis and then we will see it. But it depends on the nature of the crisis. I don't know. We did our utmost, but the complexity, and we will come back later on to this issue. The complexity of not only the system but also of what we as Basel Committee are doing is sometimes frightening. It was not only frightening to me when I was sharing the committee, because at that moment I said to myself, let's not attack specific things in detail, because then we will never come to a conclusion. But the other day I went through a calculation of items on the IFRS 9 list. And I followed the complete calculation from the beginning to the end, from the probabilities involved and the Monte Carlo model. And then I said to myself, as long as the outcome doesn't deviate too much from the previous figure, then perhaps I should feel a bit safe. But we are also creating, and this is what I want to make clear with this specific example, we are creating false securities. I'm very much in favor of using risk weights, but we should be aware of the fact that the first thing a banker is doing when you are changing risk weights is shouldn't we move our strategy to less risky activities, at least less risky with respect to the weights, not with respect to the activities. And so, again, I'm in favor of that, but it's we are giving an impulse, an incentive to banks to focus on the risk weights given by us, and we should really realize that risk weights change over time. They are not stable. We think they are stable, but they're not stable. So it is an important thing for bankers. You should look at the risk. You should try to give it risk weights. But then I come to the leverage ratio. I'm in favor of a leverage ratio that's not risk-weighted. Yeah, I know immediately the answer. I remember when we started the discussion in the committee, one of the colleagues said, "This is we go back to medieval times."
No.
Yeah, that was the Swiss colleague.
Okay.
Yeah, not you. No, not you. No. So it's a hotly debated issue, but I'm somewhere in between risk weights.
Me too.
Yeah, okay. Then we, that's why we are sitting so close together.
I do agree on the issue of interconnectedness. I think we need to gain greater understanding of the interconnectedness of the banks domestically, internationally, understanding the spillovers and spillbacks. And the other thing that I think we ought to spend time on is to go beyond numbers. You know, whatever it is, you're talking about the liquidity ratio, you're talking about the capital ratios. These are all numbers. These are all historical. And what needs to be done a bit more is thinking about how can we be a bit more forward-looking in looking at excessive risk-taking in a much more forward-looking manner. And that's where I think supervision is going to be very key. And there has to be a much more balanced approach towards addressing risk from the regulation point of view and from the supervision point of view. And you've seen that the pain inflicted from the last crisis can be minimized if there's much more emphasis given to governance, conduct, and issues around these areas. And this is where I think there must be much more work to be done together with the industry as to how we can strengthen this. Because at the end of the day, we cannot lose sight from the fact that banks and financial sector are there to facilitate real economic activities. And as we go deeper and deeper into more models, more complexity, we sometimes lose sight of the fundamental role that the banks have to play in any economy.
Thank you. With the prerogative of chairing this thing, a couple of very quick remarks on my side. Now, you were very active and played an important role when it comes to creating the GHOS group, and you used the group to make sure that things moved along so that things would not stall. I actually chose on my side to do it completely the other way around, and both ways actually worked by telling members of the committee that this is not going to go to the GHOS. You're going to have to sit here until it's decided because you are paid to decide. Yeah. And both ways work. Both ways work.
In my case, they were sitting till in the middle of the night, and at the same time, there was the pressure of, in spite of the pressure of GHOS. These were extremely long meetings. It went on and on and on. Yeah. But okay, both ways might. It depends on the circumstances.
It depends on the circumstances. Yeah. What is remarkable also, it struck me over doing this work over the years, is that if you look at how long the Basel Committee has been around since the mid-1990s, it's absolutely remarkable that there were at least a couple of attempts in the past to deal with liquidity issues, but they always failed. So it took an enormously long time before it was actually possible to come up with something on liquidity. Whether the LCR is completely right or wrong, time will tell, but it took a long time to get to that point, and that's remarkable in itself. And I think it's important because my experience, at least over the years, is that markets function the worst when you need them the most, and one should be mindful of that. Now let's move on, because now we've come to one of those questions again that somebody is managing from behind. And now the question to the audience is, when do you think we will face the next crisis? Over the next couple of years, over the next decade, or maybe never a crisis? Let's get on with it. And now my next question to the panelists is to reflect on, now given that we have finalized Basel III, and given that presently there seems to be very little appetite to introduce new rules. So then, based on this, then, what should the Basel Committee focus on over the next few years? Okay, now we have some bars here. Over the next couple of years, 50, and over the next decade, 50. So anyway, no one thinks that we will never have a crisis, and I think that's really the important thing. One way or the other, things will go wrong in the future as well. And I think that that's a reasonable point, given if you read the Reinhard Rogoff book going back hundreds of years, this time is different. We seem to never learn, and we are always at it and try to improve things, and despite that, all sorts of new problems show up. But anyway, now, the issue was really to the panel what to do next, given that there's little appetite to produce new rules. And let me add to that, in addition to the appetite issue, the phasing in periods are very long, so Basel III will actually fully come into effect by 2027. And that means that by that time there will be a new generation of supervisors asking themselves, where did this thing come from, and why is it that we're doing what we're doing? Sabine.
Well, first of all, I mean, I agree with the general statement that perhaps we should think about implementation now and not so much about additional new rules or a new framework, etc. I mean, you cannot change this comprehensive framework every 3 or 5 years. I mean, it's just not possible. Yeah? But I would like to use my 5 minutes for a side remark. I mean, I would hate to give the impression that I believe in less regulation. Yeah? Because I mean, in the last 25 years, looking backward, you can see the supervisory cycle quite well, and it's normal that after crisis, everybody asks you, and you get a lot of political support to get a tough regulation. You know, not only globally but nationally on the road, and to get tough supervision on the road. You get more resources. We talked in the last panel about budget, about political communication. I couldn't agree more with Ignacio on that point too. So it's quite normal and obvious that after a crisis this happens, and the normal cycle shows you then after some years, when the memory is gone about, what did it cost the taxpayer, tough regulation and tough supervision is not as welcome anymore to everybody as it was right after the crisis, and you can see much more restrictions coming up because there's a general idea of tough regulation and supervision hinders growth, hinders the market to strive, etc. And I mean, in the situation we are now, yeah, I do see some signs, I have to admit. Yeah, and that's why I'm giving so many speeches about let us faithfully implement Basel III. Yeah, because I do see some signs that we are on the borderline. Yeah, between getting some restrictions in our supervisory and regulatory powers. I would hate, to have the pendulum swinging back again to the other side. The first thing for sure would be for me to look into implementation and to not only like we did, in the last 10 years, to look into the implementation of the regulation by the transfer from the global rules into national legislation, and from national legislation into the implementation by the supervisor, but to do a little bit of case studies in particular with regard to the interconnectedness, to do a little bit of case studies how in concrete the supervisors use the general ideas in their approaches, in their methods, and how they implement it. I think this is very important. It's not only important under a kind of, we want to rate you in an RCAP whether you are compliant or non-compliant, but it's for me much more important to get the knowledge, to have the information exchange, not to invent the wheel new for every thing, but to have first an information exchange about methods and tools, and then to have a joint understanding too. And that this helps you quite a lot, I experience very much in my capacity as vice chair of the SSM, because we brought together 19 different ways of supervision, and I learned quite a lot from my colleagues in Spain and Italy, from the colleagues coming from the Netherlands and from Portugal, or from our Finnish colleagues, because they saw the world differently. They saw different risks, and they assess the risk differently, and they use different tools. And when you bring this together, it can help you quite a lot. So, looking forward, what should be done? Apart from monitoring the implementation, I think an intense information exchange about risk and vulnerabilities. Naud already talked about it. Shamsia too, and me too. So you see, all the supervisors here are keen to do it. But I would not only like the Basel Committee to talk about today's, and in particular about tomorrow's macroeconomic environment, but I would like to talk about the kind of measures and the actions taken by the supervisors, by the macroprudential authorities too. Because when we are talking about, we need to see spillover effects, we need to see interlinkages and interconnectedness. The same is true for macroprudential supervisor with regard to how do you interact with your supervisory colleague. The same, I mean, it was already addressed by the first panel. The same is for me correct with regard to the information exchange about supervisory practices and knowledge cyber risk. I mean, I can imagine that we all have problems with regard to the resources in this area. I mean, I see that banks have problems with resources. They can pay much more than we can pay. So I would truly ask for perhaps a joint task force where you, like the senior supervisor group did starting 2005, perhaps to work together not only on some standards, which are often at the beginning very vague, but to get a group together where you can go more in the concrete things, because we have a resource problem there. The same is true for operational, legal, and reputational risk in banks. I think we need to focus on that one much more. It's conduct, it's AML, it's many other issues where reputational aspect might lead to a prudential concern, to a capital loss, to a business model loss. And not all of the supervisors here in this room will have a mandate for AML. I mean, the SSM doesn't have it. I nevertheless believe that in the upcoming years, this will be one of the major topics where there will be requests coming to the supervisors, even the ones without an AML mandate. Why did you not act with regard to governance issues? Because all of this conduct risk, governance, AML, other reputational aspects are at least in some way included in the governance question. So how to interact, how to delineate, how to cooperate. I didn't ask Philip because this question, but I asked myself, how can we ensure that a good cooperation between different agencies with different mandates, but closely interlinked in the topics, how can we ensure that this good cooperation is not totally dependent on the people you have at the top? Management, whether they are liking each other, knowing each other, you know what I mean, are open-minded or not. So how can you create a cooperation framework on a basis which are not only, I mean, there are always soft factors in there, but which are less dependent on these soft factors. I'm pretty sure in the next panels we will talk about climate risk and the question of how do we deal with this in banking supervision. And I mean, I saw the work program of the BCBS for this year, and I think they picked almost on everything there. So a lot to do. And I'm pretty sure for the FSI, the last 20 years were quite interesting. The next 20 years will be even more interesting,
No? The next 10 years. I have to take into account my age. No, let me first start by saying that everybody knows the future is uncertain, and often Keynes is quoted by economists, but I would like to quote Grace Kelly, the future is not ours to see. She's as learned as Mr. Keynes. The future is uncertain, and then you come to the question, when will there be a new crisis, and we will get that poll later on. Let's be honest, that is impossible to forecast. And what I did is, I had in mind what Mr. Zijlstra, my predecessor, always told me, He had always quotes from the Bible, and he had also a quote with respect to uncertainty, and it took me quite a lot of time to find that quote, honestly speaking, more than preparing the rest of my speech. But it is Matthew, concerning that day and hour, no one knows, not even the angels of heaven, nor the Son, but the Father only. So we don't know what is going to happen, but we knew a few things. And that is why I do not fully agree with what you said. We knew a few things. That is, if the risk appetite, and I'm talking at a very global level now, if the risk appetite of a society doesn't change, or perhaps even increases at a certain moment, you can try to make the banking sector more safe, but the society will not become more safe. So as long as something doesn't happen with the risk appetite of the society, we will run into problems inside, or financial problems inside or outside the financial sector. And one of these worrying developments at this very moment, and admittedly it's a proxy of risk appetite, the debt ratio. It's a very global, admittedly a very global proxy. But if it is kind of a risk appetite, the debt ratio in the world went up since the beginning of the crisis. So there's one reason that a crisis is to be expected, but I come to what you said about new regulation. Another reason is the process of globalization, and especially financial globalization, and innovation will go on. And the other day, I read the book of Byron Rees, The Fourth Age, and if you read that book, you become aware again of the fact that developments are going so fast at this very moment, much faster than I smell in this room, honestly speaking, this morning. Much faster. And I'm often visiting, I'm on the board of a big Chinese bank. I'm often visiting China, and I see what is happening in that country with respect to artificial intelligence and to all kind of developments in this area. The world is changing so rapidly, and therefore also the business model of the banks is changing more rapidly than the business model of the banks changed before the crisis. Be aware of that, and be aware of the potential consequences for the financial system. But that said, if I'm right, if the risk appetite is not decreasing in the society, and there is a move into the direction of the shadow banking sector, call it the shadow banking sector, and if innovation is at a really accelerating pace at this very moment, then we really should reflect on whether, as a preemptive strike, we need not new regulations or a new type of regulation, a new kind of regulation. So I'm inclined, and here is where I differ a bit, Sabine, from you. I agree with you that as far as what is on the table now, it's all about implementation. As the realtor tells you when you want to buy a house, it's all about location. That is true, but that is about what is on the table now. But if you look at the developments in the pipeline, then I think we should really reflect on whether we need either new, more specific regulations to deal with the unsupervised sector and segments of the economy, and or whether we don't need a completely different new approach as supervisors. And I advise you to read. There are many paragraphs and chapters in that book I don't like, but I mentioned already John Kay's book this morning. I advise you to read that book as far as you haven't read it. Let me just quote one sentence, or a few sentences from him. And again, he is exaggerating the situation, perhaps, but there is some truth in it. Let me read it. The Basel process has sought to control bank activities and exposures through a prescriptive rulebook, and had responded to each instance of regulatory arbitrage and the comprehensive failures of regulation before and during the financial crisis by the proliferation of more complex rules. in frustration, yet more rules and targets are added. The results are always more complex and rarely more effective. Now, you can disagree with parts of that sentence, but there is an issue. There is one word after I left the central banking community and the supervisory community in 2011 that I really hate, and that is the word monitoring. We are always monitoring the situation. No, not monitoring, just monitoring. We are carefully monitoring the situation. But in a world that is changing so rapidly, we should do more than just monitoring the situation. Therefore, Sabine.
You heard a lot of actions coming from it too.
Yeah, okay. But no new rules, perhaps new or other rules.
And a strong supervision.
Yeah, but that reminds me of another lecture I had to deliver at a certain moment in Selling in London. And this was a marvelous story, again prepared by the excellent secretariat. It was a brilliant speech. But after the speech, in the audience, there was one person who said to me, wow, within 6 months, I have found a way to circumvent this new rule. Within 6 months. Then I said to myself how to react to that, because he was right. And then I said to him, well, you are so stupid. Nobody understood why I was saying you are so stupid. I said, a clever person could have detected that in 6 minutes. But the point is, and I'll come back to what you said, the point is you are not a trustworthy banker. And I should have the right, and I'll come to strong supervisors, but this is an ideal world in which we don't live. If I would have been his supervisor, and if I would have been the power to dismiss him, I would have done that immediately. But we are living in democratic societies, and there are all kinds of rules also for supervisors. And there's here, and so strong supervisors, yes, but within the limits of our democratic rules of the game. And then the supervisor would say, unfortunately. But okay, that's...
Just to add on to what Nout and Sabine has said, one of the things that we are seeing now is how technology is advancing so rapidly and how it affects business models of the banks, and how it even transforms some of the more traditional risks, like liquidity risk can be transformed. How we look at liquidity risk could be affected by new payment instruments. So with more digitalization, more virtual banks, perhaps there's a need to look at operational risk. So operational risk moving forward could be as big as credit and market risk. And when you look at cyber risk also, I mean, we cannot underestimate, the nature of cyber risk is different compared to market credit. Here you have what is different about cyber risk is, the risk here is we do not know what we know. And it is, it arises from targeted malicious attack. So there's a lot of work that needs to be done around this area, not just talking about standards. It's also about how can we have greater cooperation domestically, because cyber resilience is not just about fortifying the banks itself or the financial sector. You're talking about the whole ecosystem, the internet service providers, the telecoms community, and that needs to be, so it goes beyond the financial sector. So how then, at the national level, you have resilient cyber strategies, and then how it's then cascaded that to the financial sector. And as what we have seen from the last survey, a crisis is not something that we can say that we will never encounter. A crisis moving forward. So what is needed is, how can we enhance our crisis preparedness? There's a lot of work that has been done on this area, but I think it's not reached a level where we are saying that if a crisis were to happen, all of us are really prepared. And I don't think the cooperation has been strong enough that we can pick up the phone at the international level to say that this is going to happen, and can we collectively look at how best to deal with this kind of crisis? So this is just top of my mind kind of areas that I think the Basel Committee could look at moving forward. And lastly, it's about, we have to look at the interaction between the different standards, the interaction between the capital standards and governance, the conduct, and even recovery and resolution, perhaps. Because one can argue that should a buffers be as strong if if a bank is very strong in the recovery and resolution? So, and again, looking at the standards are much more holistic and not in silos is something that perhaps we could look at moving forward.
Thank you. Thank you for that. Well, crisis management is essentially having the capacity to deal with the unknown. Because if everything is known, then probably somebody would have fixed the problem earlier. So it sort of goes, that's always what happens, and then you need to decide what to do. Now, looking into the future, we have another question here to the audience. If the technology is with us, which I don't know. Here it comes. The issue is the following, that in your view, which of the following is the greatest threat to the global banking system? Financial technology, fintech in its broadest sense, cyber risk, political risk, credit risk, climate risk, or all of the above, but you can't. So let's see what happens and what your views are. Highest is cyber risk, which can have many different meaning, and that's because it's increasingly difficult to answer a question from the general public: where is my money? Is it in the cloud or on some hard drive someplace, or how do I find my money? And that's sort of a very kind of general reflection about what we talk about when we talk about cyber risk. Political risk is an issue. Fintech, credit risk, and then finally climate change, and that one will come back later in other panels. To sum it up, have the capacity to deal with the unknown and be ready to say no. And with those words, it's time to break for lunch, and thanks to the panel.
Thank you very much.